Hello good people and welcome back. So in this video what we're going to do is we're going to start with Unit 4, and in Unit 4 what we're going to do is talk about the mechanics of option markets. In the previous units what we did was introducing derivatives markets and then derivatives product, some of the derivative products that we're going to look at, and we also in the second and third unit, we started talking about futures, and we dug a little deeper on how futures market work. So we dealt with futures, and we talked about hedging strategies using futures. Now, here what we want to do is we want to look at options. Remember the set of derivatives contract that we plan on looking at are futures, forwards, swaps, and options. In the first 3 units so far already we've introduced and we've talked about futures and forwards. We're going to do some more with futures and forward because we're going to talk about valuation later. For now what we did is we were able to describe the process of hedging using futures contracts and forwards for that matter. Talked about the optimal hedge ratio, the methods that we use to find the number of contracts that are needed, the type of position that we need to take, a long hedge or a short hedge into the futures market, and so on and so forth. In this video, what we're going to do, we're going to start talking about options. And so what are options? Options are derivative instruments, and they are derivative instruments that allow for us to be, and they give us the option, not the obligation, the option to purchase an asset at some point in the future at a specified price. There are 2 types of options. The call option, or generally referred to also as classes. A call option that gives you the right to buy down the line at a given price at some point in the future, or a put option that gives you the option or the right to sell down the line at some point in the future. We remember the first unit we introduced this concept. We also talked about a European option, and a European option can be exercised only at the end of its life, that is at maturity or expiration of a contract. That's what the European option is. In contrast, the American option can be exercised at any time between its beginning trading date and the expiration date. So that is going to be the American option versus the European option. Now, with the 2 classes of options, you can take essentially 2 different type of positions, right? So with a call, we can either take a long call or a short call position, whereas with the put option, we can also take a long put or a short put position. Okay, so what does the long call do for us? The long call gives the right to buy the asset. So this is going to be the buyer of the asset. And the short call, of course, would be the seller of the asset. Now, the long put would be, in this case, the buyer of the contract, and therefore the seller of the asset. So the long put buys the right, that's what the buyer of the contract means, buys the right to sell, and therefore is the seller of the asset. The short put here will be the seller of the contract, and therefore the buyer of the asset at expiration, that is if the option is exercised. And so this is what we would have. Short put would be the seller of the contract, the right of the put option contract, and therefore would have to purchase down the line from the long put should the long put want to exercise the option. And that is, the short put would be the buyer of the asset. Now, the long call would be the buyer of the contract, but the long call will also be the buyer of the asset, because the long call buys the right for the underlying and therefore if the long call wants to exercise the option, the long call would then be the buyer of the asset again. So here for the long call is the buyer of the contract and the buyer of the asset. The short call is the writer of the contract, and if the long call wants to exercise the option, the short call would also be the seller of the asset. Those are the distinctions. So on two types of position, long or short, for each one of the contract, call or put option contract. Now, if you take a long call position, what does that mean? In contrast to futures and forward, if you remember the discussion we had with futures, we said that in the futures market, you take a position today, nothing happens, no exchange happens here, the exchange all happens at some point in the future. With option contract, on the other hand, when we take a position today, the long has to pay for the right of to the option or for earning that option, and the long has to pay a premium to the short. So in the option market, there is an exchange that occurs when the contract is initiated, and then at maturity there is an exchange that happens if the long decides to exercise the option. For futures contract, that is not the case. For futures contract, no exchange happens today, no premium is exchanged today because that's an obligation, it is not an option, and therefore all the transactions are going to happen at some point in the future. So what is the profile for a long call going to be looking like? Well, let's look at an example. Let's say we take a long call position and we want to figure out what the profit on our strategy is going to be. What does that mean? What it means is we're buying the right to purchase an asset at some point in the future at a specified price. That price is going to be the strike price. That price in this case is at $100, and we're purchasing that right for $5. So the option price, the right to purchase the asset at some point in the future at $100 is $5. And so why would we do that? Well, let's look at it this way. We essentially paying $5 for the right to purchase at some point in the future an asset for $100, no matter what the market value of the asset is. So it could be that the market value of the asset turns out to be, let's say, 150. If the market value of the asset turns out to be 150, we could buy at 100, turn around and sell it at 150 and make a profit of $50. Now, that $50 would not have accounted for our cost, which is the $5. So once we subtract the cost from it, we actually have a true profit of $45, not $50. Okay. But because the future value of the underlying is uncertain, we may find that the future value of the underlying is actually equal to $80. Now, if it turns out that it is equal to $80, we would not want to exercise the option. Why would we? It's an option, it's not an obligation, right? Why would we pay $100 for something that we can buy at 80? And at that point, we wouldn't want to exercise the option. And we would not exercise the option. We would just say, okay, we accept the loss of $5 and we say that's it. And so the profile is going to look something like this. We're going to spend the $5 initially, and we're going to wait until the price of the underlying goes to the point that it is at least equal to the strike price. Then we start considering it. So when the price of the underlying, let's call that S0, is at least equal to the strike price, then we start thinking about it. That's this point here. Can we exercise or should we not exercise the option? As soon as the price of the underlying exceeds the strike price, we are starting to recover the $5 that we've spent. So once the price of the line start increasing here, we're starting to recover the underlying the price of the option that we paid all the way until a point where we actually break even. And our break-even simply means that we've recovered the entire $5 that we spent. So this break-even point should be $105. So at $105, what we are is we are at the point where the value of the underlying here is equal to our strike price plus the cost of the option. And at that point, where we are is we've broken even, because we would pay the underlying at the strike price. We will pay for the underlying strike price by exercising the option. We would recover if we sold it, we would sell it at the current market value, which is S0, and that would allow for us to be able to recover the cost of our option, purchasing the option. Now, at any point above this value here, any point, there we go, any point above this value here, what we would have is a profit, and that is what we have here. So anytime we go above the strike price plus the call premium, we are earning a profit. So what is the call? The call gives us the right to purchase the underlying at a given price in the future, and therefore we are profitable in a call only if the value of the underlying goes past the strike price. What does that mean? It means that if we exercise the option, we would pay at the cheaper value, then we can turn around and sell in the actual market for a little more. That would be our long call. Well, the scenario would be very similar for the short call, right? So if for the short call, that is the seller of the right, what do we have? Well, for the short call, this is what the profile is going to look like. Well, the short call sold the call option and gave the right to the third party to purchase the underlying from the short party at the specified price at this over a period of time. That's what the option contract is. It is a right, it's not an obligation. So because we sold, or we wrote the contract, that's writing the contract or selling the contract, because we wrote the contract, we've received $5 for it. Where did that money come from? That money came from the long call. So the long call paid us the $5. That's what we got. And we just learned in the previous slide there that the long call is going to have to wait until the value of the underlying goes above, right, the strike price plus the call premium that he paid. And so the same process is going to occur. If the long call does not exercise the option, they're essentially foregoing the cost. And so we are okay here. We make money. We keep the $5 that they've paid us until the point where the strike price is equal to the value of the underlying. At that point, it becomes a little more likely that they would exercise the option. It's not clear, right? They may exercise the option. And so if they exercise the option, at this point, they're still losing because here they've not recovered their cost. They're going to wait, the long call that is going to wait until the value of the underlying is going to be equal to this point, that is the strike price plus the call premium that the long call had to pay. And at which point the long call is going to start saying, well, I've broken even, I've recovered my money, and then the long call is going to start thinking about exercising the option. Now, when the long call breaks even, which is at this point, the short call also pays off, or the profit of the short call are depleted, in that the short call premium that was received goes all the way back to zero. So the short call has also broken even. And what happens next? Well, the more the value of the underlying increases, the more the losses of the short call accumulates. Well, what does that mean? Well, What that simply means that if the value of the line turns out to be equal to 120, the long call is going to exercise the call option, and the long call is going to buy the underlying at $100. That's the strike price, and turn around and sell it at 120. And out of the 120, what the long call is going to do is going to recover the $5 premium that the long call had to pay and make a profit of $15. How about the short call? Well, the short call loses, right? Because the short call essentially would have to sell at $100 where they could be selling in the market for 120. Now, so the short call could have sold for 120, but because the long call exercised the option, they have to sell for 100, which means that they're essentially losing $20. But they've earned a premium early on of $5. So they're losing $100. I should have a negative sign here, or it should be the opposite. So it's gonna be 100 minus 120, which shows that they are losing $20. But they've earned a $5 premium here, so we're gonna add that $5 back, and that means that they effectively lost $15 only on the option. And so what we see is that the long call is going to make $15. That is, the long call is going to exercise the option buy at 100, which is why the short call is going to be at $100 here. The long call could turn around and sell it in the open market for 120. The short call could have sold in the market for 120. So the long call is going to make a profit of $20, but because the long call paid a premium of $5, we're going to subtract that $5 from the profit of $20. The long call is going to make a profit of $15. The same applies to the short call. The short call potentially loses $20, but because they had a premium that they received of $5 from the long call, that premium offset the loss, and the loss is ultimately at $15 only. And what we find is that the farther away the price of the underlying goes, the worse the loss of the short call becomes, right? Imagine somebody writing an option that doesn't own the underlying. So if you write an option, if you write a call option, you're giving the right to somebody to purchase the underlying from you at some point in the future at a given price. If you do not already own the underlying, you would have to go out in the market, purchase the underlying, say at 120, and then turn around and sell it at $100 per the option contract. And so the losses is literally unlimited, right? Because there's no saying how far that price of the underlying can go. The underlying can go all the way to $1,000, which means that you have minus 1,000 here, and you might find a loss of $900. Or the price of the line can go like Berkshire Hathaway, 100,000, right? If the price of the line goes all the way to 100,000, then you'll find a huge loss. So the short call is a tricky position to have, especially if you do not own the underlying. Now, how about the long put? Well, the long put, if you remember what we said about the long put is a position that allows for us to be able to sell the underlying to the short put at some point in the future. Why would we sell the underlying? Well, we would consider selling the underlying if its value is decreasing. So we can think of a long put as an insurance policy. And so this is what we're doing. In this case, we are taking a long position in the put option contract, and we have a price for that put option that is $7, which means we're going to be paying $7 for that contract. And the strike price is going to be at $70. What does that mean for the long put? The long put pays $7 and gets the right to sell at 70 no matter what the price of the underlying is. So if the price of the underlying is below 70, we can sell at 70 and make a profit. If the price of the line is above 70, what do? We don't want to exercise the option, because if we exercise the option, we're selling for low where we could be selling for more. And so we do not exercise the option. We let the option expire and we sell in the open market. So the put option, the long put option, makes a profit only if the value of the underlying, that is S0 here, is lower than the strike price, that is K. Now, this doesn't account for the cost, so we also want to account for that cost there. And that cost has to be accounted here. I should have P here for put. And so this is what we're going to have. If the value of the underlying is at 50, we can exercise the option, because if we exercise the option, what happens? Well, we can sell. Exercising the option here means that we are selling at 70 when the price is actually 50, which means that our profit is 70 minus 50, that's 20. But we've paid $7 for it, which means that we subtract the 7, we have a net profit of $13. So on this side, we're going to have a positive. On that side here, we're going to have a negative. And the negative is simply suggesting to us that when the price of the option, the underlying, is above 70, that is, the price is, let's say, at 80, what would you do? Well, at 80, you wouldn't want to exercise the option, right? Because exercising the option would mean that you'll be selling at 70 when you could be selling for 80. Why would you do that? So you would not exercise the option and you forego the $7 that you've paid, which is why the loss here is capped. The loss is capped to the $7 that you essentially have paid for the option contract. The upside is also capped because the value of the line can only go all the way to 0. So the upside is capped in this sense because the price at which the underlying is selling in the market cannot go below 0. So the best you can do, the maximum you can earn here, is the value of the underlying. That is if it goes all the way to 0. That is for the long put. How about the short put? Well, the short put does the same thing, right? The short put gives up the right to sell to the short put an underlying at some point in the future for a specified price. And so, just like what we've seen with the long put, if the long put decides to exercise the option, we said that the long put would exercise the option if the value of the line decreases, right? And so if that value of the line decreases, the long put is comfortable exercising the option. And once the long put exercises the option, the short put is losing. That is the idea. You only exercise the option if you make a profit, and as the long party in the transaction, you stand to profit from the transaction, which means that the short party is gonna stands to lose from the transaction. So the short put in this case is gonna earn a premium of $7, and the premium of $7 is gonna be reflected here because at this point, once the price of the underlying is equal to, that's the price of the line is equal to the strike price, the long put is not going to exercise the option. If the long put does not exercise the option, we keep the premium. As the short put, we have a positive outflow, an inflow here of $7, and we're fine. Now, if the value of the line decreases and the value of the line is at 50, the long put is going to exercise the option. What does that mean for us? The long put is going to say, well, I'm going to sell to you the short put at $70. That's the right that the long put purchased for $7. So the long put is going to sell to the short put, right, at $70. And the short put would have to pay $70 for something that cost $50. And so if the long put exercises the option, in this case, the short put stands to lose $20. But because they've received $7 as a premium early on, the $7 is going to offset the $20 loss for a net loss of $13. The same scenario that we had, right? So we essentially are going to buy, as the short put, we're going to buy at 70, right? Where the price is actually 50. So we're paying minus 50, we're paying $20 too much. But because we've received $7, the $7 are going to offset that, and then we're going to be at $13. So our loss here is going to be $13. All right, how about the summary of all of those? A summary of all of those that in a way that represents the payoff. The payoff is the outcome without consideration of the option premium. And so what is that going to look like for all the parties that are engaged in this contract? Well, what it's going to look like is the shape here without the option premium. So in this case, we are not going to consider the option premium, because when we consider the option premium, this is typically what we had, and this is also what we had. And for the long put, we had something like this. And for the short put, we had something like this. So when we consider the option premium, this is what we have. That's the profit. When we ignore the option premium, we have the payoff. Okay, so our payoff is going to be essentially what we have here. So that this is going to be for our long call. This is going to be for a short call. This is going to be for a long put, and that's going to be for a short put. Now, what is that payoff going to be for a long call? Well, the payoff for a long call is going to be the difference between the stock price and the strike price, right? Because we want the stock price to be greater than the strike price. Remember, we are profitable for the long call here, and we are negative here for the long call because we pay the premium. So we want the stock price to be higher than the strike price. So the payoff for the long call is going to be the maximum of the stock price minus the strike price. That's ST minus K. And ST is the stock price minus the strike price, and 0. Why 0? Because we are not going to exercise the option at all if this is not a positive value. How about the payoff of the short call? Well, the payoff of the short call is exactly the opposite of the payoff of the long call, right? So remember what we had earlier? What we had for the long call in this scenario, we had a profit of, what was that? A profit of $5 if we made. And for the short call, in this case, we had a loss. What example did we use here? Okay, we used the example of 120 here. So we had a positive value in a loss of $15 for the short call, and the same loss it would apply here for the long call. And so here, the payoff for the short call is going to be the maximum of stock price minus the strike price and 0. That is the same for the long call, but then we're going to have the negative of it, so we're going to have the negative sign of it here. That would be the payoff for the short call. How about for the put option? Well, the payoff for the put is going to be the maximum of, that's for the long put. Now, the put is profitable when the value of the line is below the strike price, so we've been profitable here. That's for the long put. And the short put is going to be profitable here. and not profitable there, not profitable there. And so we're going to have plus here and minus here. So the payoff for the long put is going to be, because we're profitable when we are below the strike price, is going to be the maximum of the strike price minus the stock price. Remember, stock price is that, and 0. Because when that is not true, when this is not a positive value, we do not exercise the option. So our payoff is 0. This is why we're ignoring the premium here. Now, what is the payoff of the short put? The payoff of the short put is the negative of the long put. So the payoff of the short put is going to be the maximum of the strike price minus the stock price and 0, and we're going to have a negative sign in front of it to show that it is a short. Now you remember that when you take a negative of a maximum, you're essentially taking the minimum. And so what you're going to have here is that this can be expressed instead, because we're looking at the negative of a maximum, we're going to be saying it is a minimum value. So it is the minimum of the two, and the two in this case is going to be the strike price minus the stock price and 0. And for the short put, we're going to have the same, because it's a negative of a maximum. So we're going to say, instead of negative of a maximum, we say it's a minimum. And in this case, it's going to be a minimum of the stock price minus the strike price and 0. Those are going to be our payoff for each one of the position: long call, short call, long put, short put. All right. So this option contract can be written on literally anything. There are option contracts that are written on a variety of underlying. We've talked about that in the first unit when we introduced these options, and we said we could write options on stocks, on ETFs, exchange traded funds, foreign currencies, stock indices, and there are even options on futures contract as well. So you can literally write an option on almost anything. Now you remember that we also said that options are traded on an exchange. So these are exchange traded options, and options can also be traded over the counter, right? So they can be traded on an exchange and over the counter. And the exchange traded options are, of course, following the rules of the exchange, and therefore have to be standardized. And so the specifications of some of those options would include the expiration date, just like a futures contract would have a maturity date or an expiration date. That expiration date is typically the third Friday of the expiration month. The third Friday of the expiration month, and the months that are typically traded on the options market follow a cycle. So that cycle will look something like this, where it is usually 3 cycles: the January, February, and the March cycle. So you're going to have the January cycle, the February cycle, and the March. Now the January cycle would have April, here, July, and October. So I'm going to write it a little better. So we're going to have April, July, and October. And the February cycle is going to have the other ones. So it's going to be May. You see this? You see the trend, right? So we go April, May. So that's going to be June. That's July. So we're going to have August here, and then we're going to have September, October. So this is going to be November, and that's going to be December. And the cycles are essentially going to be, this is going to be one cycle, that's going to be the second cycle, and this is the third cycle. And then it also depends on when it is that the option starts, right? So if the option is initiated before the third Friday of this January month, then the options that are going to trade in for these cycles are going to be the month of January, because that's before the expiration of this in this month. It's going to be the month of January, the month of February, and then we're going to have the other two months within the cycle. So it's going to be January, February, and then the 2 months in the cycle. So April and July. Remember, this is one cycle. Okay, so if you are trading, say for example, in after, if the options are trading after the third Friday, so this is going to be the third Friday of the month. After the third Friday, what you're going to have is you're going to have February, March, right? And then you're going to have the other 2 cycles in the month of January, because we're still in January here. So we're going to have February, March, and then the other 2 cycles in the month of January, which are April and July. Now, if say we were working with an option that is trading before, that starts trading before the third Friday in February, what would we have? The third Friday in February, we would have something similar to what we have in January, right? So we'll have February, and then we're going to have March, and we're going to have the 2 months in February cycle. So it's going to be May and August. So February, March, May, and August. And so if the option is trading after the third Friday, we're going to have something very similar to what we had in the scenario for January, right? So for January, what we had there was February, March, and then we had April and May. So in this case, what we're going to have is March, April, and then the 2 cycles in the February cycle, the 2 other months in the February cycle, which are May and August. So those are going to be the about the expiration, third Friday of the month, but then the month, the trading month for each one of the options depends on when it is that the option starts trading. So start trading before expiration of that month, then you use the month itself, and then the next month, and then the 2 months in the cycle. So it's going to be the month itself, the next month, and then the 2 months in the cycle. If it's trade after, that is in the case of trading before, if you start trading after the expiration month, the expiration date in that month, what we're going to have is the next month, the following month, and then the 2 months in the cycle, right? So it's going to be February, March, and then the 2 months in the cycle are going to be April and July. Now, if we are in February, and we are before expiration date in February, what we're going to need is February, right? That's going to be that month, March, which is the next month, and then the 2 cycles in the month of February. And the 2 cycles in the February cycles are going to be the 2 months in the February cycles are going to be May and August, and so on and so forth. Now the strike price here is set by the exchange, and so remember, we are working with standardized contracts here, right? Strike price is set by the exchange. We also have the size of the contract that's set by the exchange. Stock equity contracts are usually 100 shares per contract, and the options could be an American or European options. Typically, exchange traded options are American options. And you remember that the difference between the American and the European is that the American can be exercised at any point in time, whereas the European can only be exercised at expiration of the contract. We're also going to have the classes of option, which are the call and put option. Those are the classes that are traded on exchanges. Now a little more on terminology. So we recall the profile that we drew for long call, short call, long put, short put, and for each one of those profiles, we said we try to infer where it is that, or when it is that the option holder would consider exercising the option, and the moneyness of an option allows for a formal way of presenting that, right? So we're going to categorize this in terms of the classes of option first. So we're going to say we're going to have call options, and then we're going to have put option. Now, a call option is at the money, is considered to be at the money when the stock price is exactly equal to the strike price. Now, remember, when we're looking at the moneyness, we don't really worry about the premium, so there's no consideration of the premium. Right? We are looking at a scenario where we are not considering what the premium is that is paid by the long to the short. We're ignoring that premium altogether. We are focusing on the relationship between strike and stop. So for a call to be at the money, the strike price has to be equal to the stock price. For the call to be in the money, that is profitable, start to be profitable for the long. So if the call is profitable for the long, which means that it's not profitable for the short, right? And so the stock price, a call option is in the money when the stock price is greater than the strike price. If you remember the chart that we had for the call, we had something like this. So for our call, we would have that. Right? That was what we had for our long call. And so we would be at the money, and this point here was a strike. So we would be at the money at this point. Remember here we are ignoring the premium. That would be at the money. As soon as the stock price exceeds the strike price, we are in the money. And we are out of the money when the stock price here is below the strike price. So when the stock price is below the strike price, we are out of the money. So in this case, we are out of the money, we're in the money, and then we are at the money right there. That is for the call option. Now, for the put option is something also similar, right? The put option will be at the money when we are here, stock price is equal to the strike price. That is what we looked at earlier using that chart when we start considering exercise of the option. The put option would be considered to be in the money when the stock price in this case is less than the strike price, and the put option is going to be considered out of the money when the stock price is indeed greater than the strike price. And so if we remember our diagram for the put option, what we had, so this was our long call option. Our long put option had a diagram that looked something like this. So we had this and that. So we are at the money on the put when we are at the strike price, so that is going to be at the money. We are in the money for the put when the stock price is less than the strike price. That means we're in the money here when the stock price is less than the strike price. And we are out of the money when the stock price is greater than the strike price. So we are out of the money here. Now, all what this refers to is when should you consider exercising the option? Well, you should consider exercising the option when the option is at the money for an American or a European option for that matter. Now, we ignore completely the option premium because it doesn't quite matter, right? So if we account for the option premium, what we would have is for the long call, we would have something like this. We would consider the option premium, so we would have the premium that is paid, and then we can have the strike price there, and we start recovering the strike price. So as soon as we hit the strike price, we consider to be at the money. We can exercise the option at any point, even if we've not recovered our premium just yet, because as soon as we exceed, as soon as the stock price is greater than the strike price, we are starting to recover some of the premium that we've paid. So even if the stock price doesn't quite get to this point where it is fully in the money and we've recovered our premium that was paid, which is this chunk here, even if we don't get there, we have recovered a little bit of the expense that we initially had when we purchased the option premium, when we paid for the option. And so exercising the option after the stock price exceed the strike price, no matter what whether the option premium has been recovered or not, it's okay because we are reducing the potential loss that we would incur if we were not to exercise the option. So generally, an option is going to be exercised when it's in the money. An option is not going to be exercised when it's out of the money or when it's at the money, because it makes no change at the money for an at the money option. I'm going to stop here for this video, and then we're going to come back. I'm going to wrap up talking about a couple of wrap you up with this unit and talk about terminology, the various type of option contract that exists out there, and wrap this discussion on unit 3. I'll see you in the next video.